All right, so I want to make a small addition to the last video. Um, it's might be kind of interesting. I don't know. Okay, so what I'm gonna do is I'm just gonna go to the activity we made in the last video. So I'm gonna type in Grant Smith, and we'll just go to this indifference curves in a one asset market. And I just like to click the ellipses and open an app. Okay, so it's opening up. All right. So there was a point in the last video in which I said something along the lines of when we're at 1-1, I was like, well, you'd prefer to consume now rather than later, so you probably wouldn't take this asset. And then I did something like this. I moved it up a little bit, and I was like, okay, now we have a little bit of an interest rate. You'd probably buy some of this. So that's not totally correct because this 1-1 right here, what is this? It's trading off a dollar today for a dollar tomorrow. What's that equal to? That's just putting money under your mattress, right? And people put money under their mattress all the time, right? So when I said, you wouldn't take that, you actually would, and you do all the time. So all it means is, let's say you're given $6, right? You have $6 to start, and now I'm just gonna get this out of the way for a second. You've got $6 to start. The only asset that's available to you is just putting money under your mattress. So now the question is, well, let's do our same little procedure. Let's move this utility function down. And sure enough, or we're going to move our level curve down. We're not changing the utility function at all. And now we're just coming up here and we're saying, okay, how many do we, well, we have we're going to use 3 today and 3 tomorrow because we're trading off 1 for 1. We started with 6. Our indifference curves and our utility function, that's not totally right, but the one we have here, just for simple example, treats today and the next day as the same, when really you should value today a little bit more. No big deal though. So this utility function in particular, it has the two dates as equal, right? And our utility is 3. Whereas, if we move this down, I guess down or up a little bit, but in any case, we're increasing the interest rate. So now we pay 20 or 80 cents today and get a dollar tomorrow. That interest rate is 25%. So my guess is our utility is going to be a lot higher because we have something great to trade, right? So, and sure enough, that makes contact here. If we move down a little bit, what's our utility at that contact? It's 3.3. And when the trade-off was 1-to-1, if all we had was the ability to put money under our mattress, we ended up with a 3 utility. Whereas if now we're allowed to trade for a bond at 25% interest, now of course our utility is going to be higher in that case. Okay. And so now there was one other scenario that I wanted to talk about briefly. And remember, I had it up here. At the time it was reversed. So let's talk about like right here. And so what I was saying was, okay, you have to pay 20 cents today to get a dollar tomorrow, right? So 20 cents today to get a dollar tomorrow. And I was like, anyone in their right mind would take that trade, right? And the thing is, that's true, but they would still only do it to a certain extent because you need some amount of money today. And so what that looks like is all we have to do is just do our same thing, right? So let's get this out of the way. I'm going to move it up here for now. But now the line we're intersecting is so slanted because now we're so, like right here, we're intersecting, right? But now if we have such a great interest rate, we're going to move all the way up here. So we're going to move our utility function. We actually might have to change our max. Sure, yep, we have to change our max. So I'm going to change this from 5. I'm going to put it at like 10 or something, okay? And now I'm going to keep moving it up until they intersect at a tangent. Okay, something about right there. I'm going to move E to about that intersection. Okay, and so what does that say our trade-off is going to be? At this intersection point, we started with $6 today, but we have some asset that risk-free multiplies our money by 5. So what are we going to do? We're going to spend 3 of those dollars today. We're going to put 3 into that asset, and then we're going to get that payoff of about 11 later. So this, and now what's our utility? It's 5.8. So because we have such a great interest rate, even though we're not 100% putting our money in there, our utility's still going up. We're still having some amount of consumption today. We're still getting a ton of consumption tomorrow. So this is how the equilibrium would be. I don't know if I'd call it an equilibrium. This is what your optimal scenario would be if you have such a great asset to invest in. So thanks. And one of my friends was telling me I should tell people to like, comment, and subscribe. So feel free. That's a joke.